Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to go through Twitter like we normally do, check to see what people are sharing on social media. I'll interject my financial opinions, and it's generally three topics: commodities, wealth building, and/or financial topics. So let's dive in there. Let's see what's going on and what people are sharing. If you want to follow me, it's at finding_finance. And if you want to join our community, finding-value.com. We still have the holidays coupon code that is active if you would like to join for 2024. So Chris Peruna. So Burry on January 1st, 2023, looking back at predictions. Well, that was wrong. Burry has a history of being right, but on the wrong timeline. Rate cuts will likely happen in 2024. Will a recession happen in 2024? Question mark. What about another inflation spike? Perhaps those two can happen next year after the election. Don't know. Michael Burry said inflation peaked, but it is not the last peak of this cycle. We are likely to see CPI lower, possibly negative in the second half of 2023. And the U.S. recession, by any definition, Fed will cut and government will stimulate. And we will have another inflation spike. It's not hard. At least that's what he put. Now, here's the tough part. It's nailing the exact timeline right. So I think he's got the sequence of events right. The problem is, what time is this going to occur in? And furthermore, how big is the pullback going to be? Is it going to be papered over nominally? So we're in the middle of a demographic and we're in the middle of a real estate expansion phase. If the housing starts go up, we will not see a recession. The recession or the slowdown is probably behind us. If we have a slowdown and you're going to see it in the housing starts dipping, we could potentially be in a slowdown if the housing starts dip. But we see strong construction spending, strong construction employees, and housing starts just last month went up to 1.5 million. But again, we'll have to monitor it and see how those metrics are doing over time. Disinflation is transitory. Strong growth shows that disinflation was largely due to a one-time improvement in supply chains and labor force participation. An easing in financial conditions could rekindle demand that makes a return to 2% inflation unlikely. So Joseph Wang is in the camp saying that a return to 2% inflation is unlikely. Okay, that's getting interesting. $1,000 mistake, holding a losing investment too long. $1 million mistake is selling the next Tesla, Netflix, or Apple too early. Develop a bias towards not selling or holding your investments longer. That's exactly what I've been doing in my account, and I've been reaping the rewards from holding on to my winners and then consolidating potentially out of my losers and into other great opportunities. Someone may ask me, when is it a good time to sell a stock? And I would say, when you think something else is a better opportunity, then you can sell it because you have something to go into that's a better opportunity. If you're just selling something because you're up and you just want to lock in the gain, you have to have something else to go into. If that thing that you're selling is still of undervalued and of very good risk reward. So if the risk reward is still good, if I still believe in the company, if they still have a lot of growth in front of it, and I'm up 5 times or 10 times my money, I'm still not going to sell it. Because if the conditions are still good and if the company is still great, why would I sell it? And what else am I going to go into? Here is Valaris, strong 3-year deal with Petrobras on DS4, one of Valaris's lowest spec drill ships. Effective rate in the high 400,000s per Valaris release. Includes mob fee, though DS4 already in Brazil. Strong contract for Valeris at first glance, good industry data point. This is a company that I am invested in for a good while, and I think it's a pretty solid pick. And yeah, it's good. Unpopular opinion: utilities will be the best performing sector of 2024, and utilities do well towards the end of a business cycle. So Michael Gayad thinks that we're towards the end of a business cycle. If we get housing starts to rocket higher, he is positioned in the wrong part of the cycle. So he's not accurately identified where exactly we're in the cycle. I don't blame any of these people. It is a very difficult thing to nail here. And the reason it's difficult to nail is because the yield curve inverted off of stimulus. It did not invert solely off of the movements in the real estate market. We could get a slowdown if they over tightened and the real estate market can't support the tightening. I agree with that. The problem is, did we over tighten? And that I don't know. I don't know if anyone knows that. And I don't know if the shortages in the real estate market can overpower the softness in other sectors like technology or whatever else is going to weaken. It could be commercial real estate, could be whatever it is. So that's really the question that they're trying to solve: is the slowdown greater than the movements in the expansionary phase of real estate? Now, in an expansion phase of real estate, we have never seen a recession where if housing starts are going up, we've never seen a recession during that market condition. Never in history. Could this be the first? Maybe. Because maybe there's something else in the market that overpowers it. I don't know. That is what makes this very difficult to project and predict. This uranium supply gap chart shows why new uranium bull market has many years yet to run, driven by the growing imbalance resulting from today's nuclear growth rate versus future U3O8 supply. As a forecast, I mean, look at this, guys. Look at 2040. That's like a 94 or 95, 96, 97% supply gap of what we've got basically in production today. Yeah, production today, we are ramping up quite a bit. We're gonna, we're coming in here 2024, then 2025, late 2020s. We got a good ramp going on, but we're still in a deficit even with that ramp. It says uranium is projected to face a persistent supply-demand imbalance with a cumulative gap of around 680,000 metric tons by 2040. Just a small gap, guys. Small gap. Small cap stocks not been working. Obviously, India, Nifty Small Cap 100 at all-time highs. India's got a really good demographic for investing in that country. The demographic moves pretty steadily outward. There's good growth in their demographic with the younger population, and that's generally what drives demand for products and bank loans, et cetera, et cetera. So I think India and their demographic they're probably going to do very well. Gold Ventures. So welcome to junior mining. What volatility? So this is Hercules Silver Corp. I've seen Hercules been throwing around by a lot of people. And the place to buy this is before. Your risk reward is when you get in around 0.25. That's your entry point. Then you ride up. You could have an entry point at 0.3 as well as it starts to move. But your entry point, in my opinion, isn't up here. This is a Batman pattern, and then it gapped down quite a bit to the downside. I don't know what happened with it, but I'm sure they could have hit something. Sure, that's great. This is a very speculative company, and moves like this can occur. This move looks like previous trading session was about $1.35, $1.37, and now it's at 92 cents. So it's like a 40% decline in one day. So these small speculative companies, you got to be careful with your entry points and how you want to enter these things. But again, I don't have too many junior mining companies. I think that the risk reward favors too much risk and the probability of success is pretty low. Some technical warning signs beginning to arise in uranium miner and refiner Camco. Important zone 4142 followed by open gap down by 38 bucks. The last time CCJ dropped below the 50-day SMA in October, it consolidated for a week and then resumed its uptrend, which is back here in October. So we came on back. Yeah, it looks like we could have a little bit of a pullback, but is this pullback done? Don't really know. I really don't try to time the short term, guys. I mean, I try to time my purchases as best you can. That's all you can do. And then if you've got positive market conditions, ride the thing. Ride it for as long as you can. Some people get really scared in the short term based off of the price. They use the price as a justification of if they're right or wrong, and then they get scared and sell out. I mean, that's basically mostly everyone. You shouldn't be looking at price. Price is a symptom of a market condition. So you should be looking at market conditions of uranium, much like the supply gap that we were talking about up here with this. So if this supply gap is big and it exists, I would play the entire trend until the supply gap is fixed. But there very well could be big pullbacks in the middle of that supply gap and the credit expansion in the system. So yeah, you could get 30, 40, 50% pullbacks even in that big secular bull market. They could be cyclical pullbacks in it. But I would ride through it. I wouldn't try to time the short-term market movements. That generally ends up a gigantic disaster for most. The yellow bubbles show the rare points in history when the estimated S&P 500 total returns were actually below the yield of the 10-year Treasury bond. And you can see what occurred in all of those time frames. This is positive for a commodity bull market to occur because this also occurred in the late 1960s, early 1970s. There's your circle. It occurred in 99, 2000, which also was another big bull market for commodities. And then just recently here, I'll get it back in there, guys. Just recently here, you can see that we are throwing the same signals in 2020 and also today, which is a good thing because I think this is correlating with the 2000-2001 era and also the early 1970, late 1969 era. That is very good information for a commodity bull. If there's a holy grail of trading, this is the closest thing. So this is what to buy, and I'm going to read the 3 traits. So what's the trend of the market? If it's negative, you'll want to do very little, if any, buying. Even if you see some stocks breaking out, your probabilities of success are quite low when the market trend is going against you. What I consider that to be is market conditions. What is the trend of the market? Which few groups look the very best technically? The importance of this question can't be overemphasized since my studies have consistently shown that 2 equally bullish charts will perform far differently if one is from a bullish sector while the other breakout is in bearish group. The favorable chart in the bullish group will often quickly advance 50 to 75%, while the equally bullish chart in a bearish group may struggle to get a 5 to 10% gain. So what he's looking at is he's getting the tailwinds behind him with the market conditions. Then he uses technical analysis for his entry point. And then he uses the market conditions and the winds behind his back to get him his returns. It's exactly what I do. Once you determine that the market trend is bullish and group A acts the very best technically, the final step in the process is to zero in on the 1 or 2 best individual chart patterns in that sector. And that's what I use to determine my stocks is fractals. And that's what he's doing. So this is the ideal time to buy is to do exactly what I'm doing. And I even threw in another mix under the market conditions is to ensure that you have good valuation on your side. So if you can have good valuation, you see the market trend is shifting into a positive environment, and you choose technical analysis to time your buys as best you can, that's the greatest probability of success at the best asymmetry in the stock, etc., etc. It's basically the best entry point that someone can do. That is what I have found in my personal experience. And it matches this book as well. Sector rotation. So we're talking about industrials versus technology here. We also have the Russell 2000 small cap divided by the Russell 1000 large caps. And then in the middle, we've got equally weighted S&P 500 versus market cap weighted S&P 500. And we can see that we are coming from these high areas in the ratio down to low areas that we're putting in bottoms, where there is a sector rotation. And that sector rotation is going from large caps to small caps in the top two, and from technology into industrials, which is also another sign of commodity boom. So these are more evidence of the market conditions shifting back again to a commodity bull market, hopefully. Coming on back down, the three most important words in investing is margin of safety. Margin of safety, I posted this margin of safety chart so we can go over it. The intrinsic value of a company, you can see that this is dipped way down into a buy zone, and this is time. You can accumulate, and this could go up and down. This is really the stage one sector of technical analysis. Stage two is when you're coming out of this buy zone. You buy it when it's coming back up in stage two. So stage one is this whole bottom. Stage two is when it breaks out and we're still in the buy zone. And that's your margin of safety versus the intrinsic value of the company. That is your ideal buy point from margin of safety standpoint. We can identify this in the margin of safety using ratios. The technical analysis will also get us good entry points, but you have to have a long enough time frame to be able to hold for that to work. So what Warren Buffett, I haven't really heard him talk too much about time frame, but time frame is 5-10 years plus, or hold it forever, depending on the stock and the sector that it's in. So time frame is it's completely essential to hold these things long enough for that to work, to be a value investor. Remember, earnings only come out once a quarter. 4 quarters is a year. And if you're inflecting in a company, it may take 4 quarters for it to inflect. It may take a year for the earnings per share to inflect. It may take another year for the stock to actually start getting some momentum and moving. And those earnings have to continually inflect positive. This is important data to highlight the following. The aggregate weight of Apple and Microsoft in the S&P 500 index is now larger than 4 sectors combined, and 70 times greater than the entire metals and mining industry. The level of dominance by 2 companies is unprecedented. More importantly, being a significant portion of the market can be incredibly positive on the way up, yet it can also amplify the downward pressure when the market is headed lower. And this is the magnificent 2 in terms of percent weight in the S&P 500. The Apple and Microsoft is 14%. Energy, real estate, utilities, and materials sectors combined is 12%. Energy sector's 5%, and metals and mining industry is only 0.2% of the size of Apple and Microsoft alone. Just crazy. Crazy valuation differences. A tolerance for short-term market swings improves our long-term prospects. And that's what is required to play in this game. We've got the SPX versus the US Producer Price Index. We've got a historical breakdown from the 15-year bearish pattern. It's just another brick in the bullish commodities wall. Now backtesting. So we've got a breakdown, and then we're doing a retest here. And then eventually this is going to fall where the Producer Price Index and or commodities will outperform the S&P 500. It is coming. We are at the beginning of this commodity bull market. Psychology of money. Rich is the current income. Wealth is income not spent. Wealth is hard because it requires self-control. No, that's psychology of money. Warren Buffett always puts it best. We prefer a lumpy 15% return to a smooth 12% return. Investors who'd rather have the reverse should ask themselves whether their aversion to volatility is mostly financial or mostly emotional, says Howard Mark. My returns are very lumpy. They are very, very lumpy because the volatility is big. And that is how you get the larger returns, is you have to go after the volatility. Sometimes in the short term, the volatility is going to make it look like I'm wrong, or it's going to make you look like you're wrong. And that's where you need conviction in the stock. That's where people, if I were to share, good companies, they're going to say, oh, it went down 10 or 20% in a year. You were wrong. And it's like, well, not really. That's just the market volatility. And you have to take a time frame where the market conditions really turn in favor. In the beginning, things are slow because you're buying in a base, or you're buying it where it just broke out of a base and it's going to consolidate still. The big moves come towards the end of the market. The problem with buying at the end of the market is you have no margin of safety. So you've got all the risk in the world, even though you're seeing your account move very fast in the short term. The lowest risk entry points are the most boring in the beginning of the investment, and then they are the best at the end. And that's where you have the best risk reward entry points. They're very boring in the beginning. The real key to making money in stocks is to not get scared out of them. And that's that volatility and knowing what you own and the conviction in the stocks that you hold. This is the housing market in China. Home sales fall again as policy shifts fail to stem the decline. They can't do anything about it because their demographic has declined in the area that they're in. They can't do anything to increase home sales if there's no people to buy it. They're overbuilt, and they've got a deleveraging event. It says, I love investing, but your personal finances are 10 times more important than stock picking. Follow this playbook to your finances bulletproof in 2024. So number one, we'll go through this real quick. Get organized, optimize your insurance, align your spending, start an emergency fund, eliminate high interest debt, get your employer match if you can get it. Full emergency fund is there. Health savings account, individual retirement arrangement, kids education, eliminate remaining debt, and build wealth. That is the steps that someone should have for the financial playbook. And this is more important than trying to mess around with investments if you're not in a good, healthy state financially. And that's where we're going to end it, guys. So that's what I've got for today. Give me a thumb up for the content. Subscribe to the channel. Subscribe to the website if you'd like. We still have that discount holidays for the coupon code. And that's all I've got. So we'll catch you next time. This is Finding Value.